I don't think there's that many people that are doing social media around the alternative financing space. I think you've taken a great leap.
I think what differentiates us, putting ourselves outside of the box of what the merchant cash advance or MCA has this kind of negative connotation or aura around it. MCA is. A few weeks later, I had an office. A few months later, I had some employees. A few years later, we've done north of $1 billion in transactions. We have 176 employees across the country. We have 4 offices. And our goal is to, in the next 3 to 4 years, be deploying roughly $1 billion a year.
Welcome to the podcast. Today we have a special guest. His name is Jay Avigdor. He's the CEO of Velocity Capital Group. He's been funding for a long time. He's got tons of information about just the ups and downs of business, especially in the merchant cash advance world. Most importantly, he's a funder, so he's looking to do more business with more individuals, funding quite a bit of money. You want to start off just telling us a little bit about Velocity and what you do?
So first and foremost, I'd like to say, Velocity's not in the MCA space. We are in the revenue-based finance space. There's a big difference, truly. I would say that the merchant cash advance or MCA has this kind of negative connotation or aura around it. And, I think what differentiates us is kind of putting ourselves outside of the box of what the regular MCA is. I said on a previous podcast, which was what is the difference between, MCA in our eyes is kind of like the marijuana street dealer, right? Unregulated, undocumented, no licensing, zero, regulatory scrutiny or any sort of backlog. And then you have revenue-based finance. Now, revenue-based finance is the medical marijuana that is licensed, that actually has the licensing, it has the infrastructure, it has the institutional backing, it has the regulatory documentation and all the right paperwork, right? That is the difference, right? So a little bit about Velocity. Velocity's been around since 2017, beginning of 2018. Started out of my spare bedroom in my home, just myself, a folding table, and just a laptop and maybe an extra screen eventually. Started out with a free 30-day subscription to DocuSign, and I had some industry knowledge and I just ran with it. And, a few weeks later, I had an office. A few months later, I had some employees. A few years later, we've done north of $1 billion in transactions. We have 176 employees across the country. We have 4 offices. And our goal is to, in the next 3 to 4 years, be deploying roughly $1 billion a year.
That's awesome. 2 things I love that you said there. One, I do believe that there is this there's some kind of misconstrued notion about merchant cash advance. So I like that you kind of separated that. Me and Cameron talked about this frequently. I like to call what we do creative finance because I was spawned from the brokerage side and now we fund quite a bit as well. But it's like I couldn't start funding without the income from the brokering side. And what I really like to say is that we're a creative financier. We're a financial advisor for our clients. We want to mix together asset-backed lending, SBA lending, mixed in with alternative-based financing, revenue-based financing, whatever it is. That way we can create these types of deals. So anyways, I really just like that separation. I don't think there's that many people that are doing social media around the alternative financing space. I think you've taken a great leap. I know I've been trying my best to create a great leap right here, but there's just not that many of us. And I think that there's going to be...
Why, though?
Well, I think people are scared. They're hiding behind the products in the wrong way. You see a lot of aliases. You see a lot of people that are sending out term sheets or sending out things that are unjust or unethical. And that's why those people won't be a man and be a face of their own business. And that's why I think that we're sitting here today, which is great.
The real difference to me is that if you're shy about what you're doing behind the camera, you're not going to be in front of the camera, right? So if you have nothing to hide, you and I, we're doing kosher business and we're doing things the right way and we're talking to merchants respectfully. We're doing reconciliation policies. We are giving merchants the benefit of the doubt. We are working with merchants on a daily basis to make sure that they are handled with respect like they should be, and they're not just another number on a spreadsheet. Then there's nothing to hide behind, the camera. You can do it in front. And if you have knowledge like we do, to have, thankfully I've had north of 18 years of industry experience coming next month. And, I have what to share and I want to give it to my kids and my employees. I want to give it out and all the hard, their struggles, to say the
Yeah.
least. They've allowed me to learn from said situations, right? Whether it was COVID, losing all of my employees, whether it was, being put into technical default for my facilities, losing lines of credit, losing office spaces, losing lines of credit, having employees create this kind of upheaval and this mutiny that I had to get rid of them right before COVID, restaffed over 75 people. And then within 4 months of restaffing, COVID hit and had to kind of shut things down, pivoting, then having a bad line of credit, so, every single hurdle has given me, and every single, how do I say this? Every single bad situation that's ever happened to us has been a learning experience.
Of course.
That we are proud to have gone through because it makes us stronger.
Well, I think there's a lot to say that there's a lot of competition in this industry. It's low barrier to entry. There's not a ton of regulation yet. It's coming. We're watching it happen. And this can kind of bring up a talking point. Like, I'm kind of a fan of regulation as long as it's controlled regulation. Like, I don't think that states should be doing these blanket policies that just say you cannot do merchant cash advance, you cannot do revenue-based financing, your contracts have to look X, Y, and Z. What's happening is, in the example is Virginia, they basically said they were the first state to actually pass any type of financing or any type of regulation, as you know. Basically said, like, hey, you now have to report all deals if you do over 5 in the state of Virginia. And we're like, okay, cool. How do we submit that? And they're like, oh, we don't know.
Yep.
But you have to start doing it in September. We're like, so you're telling us that we have to do this protocol, this workflow, to give you all the business, to show you all the business that we've written in your state, but you don't give us a way to actually do it. So, that's just an interesting about regulation. But the point of the matter is, it's very competitive. Some might say even like a sharky industry. People are leaving people are screwing people over. I think there's a lot of individuals that are in the industry that don't see the long-term vision. They're just trying to make big commission checks really quickly and early on. They're not real business owners. They're just kind of like fly-by-night, high-ticket guys. What's your perspective on regulation? How have you navigated it? What challenges have you faced?
So when it comes to regulation, we are obviously completely pro-regulation. I think that there's a lack of urgency to the regulation. People are scared of it, and when embracing it, it obviously creates opportunity for those who do it correctly.
Right. And it costs money. So it's like, if you have the money to be able to overcome it.
If you're able to do it accurately, it's not that much money, and it's a lot of automation.
Well, it's more than a brand new guy that's just kind of getting started. Like, you do have to have a couple $100,000 to be able to throw at regulations.
Let me put it to you this way. When I started in this industry in 2009, okay, when we would get a 60-day deal, we would jump up like, how did we get a 60-day offer? Right now, if you gave a 60-day offer, I was with a lender. I was at one of the first. I was their 7th hire. But the fact is that those were good offers back in the day, right? And now, fast forward, kind of the evolution of the industry has become, you're not even in the conversation if you're giving an offer like that. Whereas the industry has evolved, absolutely. Exponentially it has. I think it's become more of a, like we said, an MCA to merchant cash advance to now revenue-based finance / creative finance. And getting into that, on a regulatory level, when you talk about Texas, Virginia, California, Connecticut, New York, and all the other states that are adding, disclaimers, disclosures, documentation, registration, etc., you have to look at it as, they're trying to put hurdles in front of us.
Right.
If they would have been able to prevent it and outlaw it, they would have already. Now, you have to look at it as, if you're actually really purchasing a percentage of future receivables and you're doing it correctly and you're reconciling and you're actually purchasing the accurate percentage, which we have
writing that SP on the contract correctly, having the numbers to back it up.
Correct. Now, we have an entire reconciliation department that literally, it's 6 people that this is their job. And they reach out to merchants and they, retroactively are trying to make sure that they're reconciled accurately. Now, if you're doing it correctly,
that's
number
a great
one,
way to be proactive.
Yeah. So, I mean, you can't tell me that someone is going to say, well, it's not a real purchase. It's not a real purchase of future receivables. Well, It is, right? If I can provide proof to that, then there's nothing to have a conversation about. Now, if somebody is doing it inaccurately and they cannot adhere to the laws and regulatory scrutiny, then they can't be a part of the industry. And that's what I think that's going to weed a lot of that out.
Well, I think there's also the collections and sales practices I think are more important personally.
Yeah.
It's like you can't have a brokerage shop that's promising the client the moon and the stars and saying you have to take this deal first. And I feel like that's what I run into most frequently when we have clients that are, being disgruntled about the way that it was sold. And then also there's, other funders that are in the space that have aggressive collections tactics. And, California's cracking down on the way that you can collect, the hours that you can call the business owner. You can't call them past 6 p.m. local time.
I think that the biggest hurdle that the industry has had is that, the funders in the industry, as they have their semblance of liquidity, they kind of lose a lot of their underwriting infrastructure as the liquidity blurs their mind. Right, so they're just going to fund because they got to push the money out. Right now, if
that catches up though, because they'll push the money out cheap, and then the defaults catch up.
Correct.
And then they
so
reprice.
If you're disciplined in the time of when you have the liquidity, no matter how much liquidity you have, you're not gonna. There's nothing that can really happen to you, or very limited that can actually happen. Now, when you're talking about scrutiny and brokerages who are deceiving small businesses, I believe that it is the funder's obligation to educate the small business owner because they are not aware of what the broker promised them. Now, on our funding calls, we ask the merchant, did your broker promise you any additional financing? Did they tell you if you have, correct. So if you have, did they promise you any SBA loans within the next 30 days? Is there any fees
tied to this?
Are there any fees tied? Did they promise you that after 30 days, you don't have to make your payments? Did they tell you that, hey, if you make these payments, we're going to get you more money and more money, more money. It'll cover all the other money. Don't worry about it, right? These are red flags. And, you can sell the merchant and believe that the merchant understands what the broker's selling, and then the funder just funds, right? Yeah. It's the funder's opportunity up front to call the merchant and ask them, did they promise you X, Y, and Z? This is what happens. And if they tell you something and it's not true, and you're not, if I asked you if you're going to take financing in the next 30 days, and they promised you, an SBA loan in the next 10 days if you make the first 2 weeks of payments, and you're not honest with me, I have that on a recorded line. Right. You cannot tell me that somebody tried to deceive you when I openly asked you and you lied.
Yeah.
So who's at fault? Right? Another thing that we add is, debt consolidation, a big problem, right? Where they are active. We've recently heard recorded phone calls of these debt companies. And when I say debt con, it was actually a con.
Oh, yeah.
They were telling them, don't worry, don't answer their phone calls, don't answer their text messages or emails. We'll make sure there won't be any legal ramifications. They're not going to sue you, etc. And it was literally false. And then they hang up and then they make you sign something, right? So, on our calls, we literally tell merchants, before we let you go, you will receive, it used to be you might receive. Now it is, you will receive calls from debt consolidation companies promising you X, Y, and Z. Here's what will happen. They will stop your account. They'll tell you to do this. And we walk them through the process because we are trying to give them every possibility and every opportunity to succeed.
Right.
And that is who will succeed in the long run. The entities and the companies that are walking their merchants through the process, giving them the tools and education to make sure that if there's a hurdle in front of them or a stone or a rock, don't trip on it, because I'm telling you, it's going to be there. Be prepared.
Well, I think regulation can actually help that too, because if it's more defined what the rules are, there's going to be less scrutiny for debt consolidators to be able to, get in their heads, right? Because it kind of depends on what judge you get during collections at this point in time. But as the regulation kind of evolves, I think it's going to be more clear cut of what is allowed and what's not. Therefore, we can kind of work around those debt consolidators. But I guess there's always just going to be a yin to the yang, right? There's always going to be an equal opposing force to kind of counteract what we do. But
there's always, just to say, there's always precedent in the market. If your documents are airtight and you're making sure that you are adhering to the rules and the guidelines of the industry, and you are actively providing reconciliation procedures, and you are offering the right documentation, the right education, doesn't matter what judge you draw. There's precedent stating that it is X, Y, and Z. And yeah, you might draw the wrong straw once in a while, but the overall is it's a real purchase. Yeah. And the way I like to do it is like this, right? And this is how I really, I really kind of itemized even to new employees. Ready? I'm going to role play.
Okay.
What is a revenue-based finance? Play it out.
Purchase of future receivables.
Great. I like your watch. It's nice. I'm a watch guy, right? I like your watch.
It's just a little date just.
Yeah, great.
It's actually the first watch I bought as I started becoming successful when I was just a broker.
I love it. You know why I like watches? Is because every time I look at it, it reminds me my time is really freaking valuable.
Oh, yeah.
Right? So don't waste it.
Yeah.
So that's kind of my reminder.
Yeah.
So I'm going to role play with you.
Is that the Royal Oak?
Yes.
I got a Royal Oak as well.
It was a gift. So,
there you go.
Yes. So
who was that gift from?
A family member.
Okay.
To say the least, yes.
Let's get the role. Yeah, I got some things I want to say too.
Got you. I like your watch.
Okay.
Beautiful. Let's just say it's worth 20 grand.
Okay.
I'll give you 15.
Probably not.
That's what a revenue-based finance is.
Right.
The receivables in this scenario, aka your watch, is worth 20. And I'll buy it now, your future receivables. I'll buy it now for 15. Right? That is what we essentially are doing.
Right.
Now, if you're buying something,
it's a great way to put it too.
It's a simple. So my question is, how do you
there's the value
that?
In the time frame.
Correct.
You're getting this money in 1 to 2 days.
Correct. But how do you regulate that? Because if you regulate that, then if you want to sell me your car for under market value because you need cash quickly, you have to regulate that too.
Yeah.
If you want to sell me your actual watch because you need cash quickly, you need to regulate that. Anybody that wants to sell stock on the open market under value, you have to regulate that, right? If you want anything for quick cash, you're going to have to regulate that.
Yeah, but I just don't think it's that black and white.
I think that there is an essential reason why it has not been outlawed.
I think it's more business rather than consumer. A consumer is not going to be considered as educated as a business owner that is generating a few $1 million a year in revenue, right? So they're naturally going to be able to be held on a higher status or at a higher pedestal of like, you know what you're signing. I think that state by state or federally, they're going to be more looking at the consumer as a, the person, the single mother of 3 that is in credit card debt and is factoring their future paycheck. Like that's going to be a bigger cause for concern in American society than an educated business owner making a decision, I would think.
True, but you said before that there are bad apples in a handful of bad apples in the industry, and the question I would ask you is, tell me an industry that there aren't.
Oh, you could sell, art. You could be in charity,
bad boat
nonprofit.
Dealers, there are bad car dealers. There
100%.
are bad people in real estate. There's bad people in
100%.
construction. So you cannot itemize one industry that's bad when if you look at any industry, there are always bad apples in every industry.
100%.
Now, people like to point fingers, and that's okay. But I'm sure that every industry that anybody watching this is going to be in has a bad actor.
100%. 100%.
So I wouldn't point fingers. I would more so look at who's doing it correct.
Right. I just think that if an attorney general wants to crack down, they're going to pick someone to make an example out of, which they've done in the past.
They've done,
yeah. So, but anyways, lots of good stuff about regulation. It was just coming to me earlier today as I was walking. I just showed up here in New York today. We have an office down at 40 Wall. I was walking around our brokerage floor with about 20 brokers, and I saw on maybe half their computer screens a Velocity offer today. So that was just fun just to see that. And I was like, oh, I'm going to see Jay tonight.
Yeah.
So.
Actually, I used to be on 40 Exchange. So
oh, nice.
Right there. Yeah.
Cool.
So,
hell yeah. The first brokerage shop I ever worked for as a broker was in 40 Wall. Then they moved to 55 Water, and I came back to 40 Wall and now have an office there. So it's like kind of cool that it came full circle.
Yeah.
Very fun. But I do love coming back to New York. Don't think I would live here again, but
you're a farm boy.
Yeah. Well, I mean, not necessarily. Like I went from New York to Miami for 3 years. So like I do like the city, but I just don't know if I could do New York's just a little too cramped for me.
I don't love the city.
But I do love, yeah.
I'm Long Island.
Long Island. Gotcha.
Cedarhurst.
So great. much more room.
Yeah. A lot more room. Smell the fresh air. It's nice.
Well, let's go back to the beginning. So you said something at the very beginning of this pod. You're describing how you had a foldable table.
Yeah.
When I started my first brokerage shop, and I've been a part of sales and several different brokerage shops, what have you, I was 23 years old, and I got a bunch of college kids during COVID to cold call for us. We got a shitty office for like 50% what the price was, and we literally went to Walmart. We bought 10 foldable tables, and we had like 18 people just come in and on laptops start cold calling. So, you know, I know the grind. I love the foldable table story. It just like kind of identifies like the rough and tough way of a true entrepreneur, how you can get started. Let's hear more about like how you actually got started. Let's hear some of these war stories that you have.
It's great. I mean, I resonate heavily with that because, you know, I've always said, you know, there's two types of people in this world. And, you know, you talk about my book. My book is coming out, please God, in October.
Let's tell them about your book real quick.
Yeah. So my book is called Need It, Don't Want It. It comes out, please God, in end of October, early November. It's literally exactly...
Only 100 more edits.
No, I actually just signed off last week on the final edits.
Nice.
It was like kind of like a signing your life away feeling. I was like, you know, it was a passion of love. It took me three and a half years.
Yeah.
It's about where I am today as an entrepreneur to where I came from.
Yeah.
Right. So it's basically backwards. It goes 12 chapters. It's 12, 11, 10, 9, 8, all the way down to 1, which is, you know, one of those type
But in descending order from 12. So you're telling your story backwards.
Correct. It's basically where I am.
It's so unique.
And yeah, it's kind of like the Benjamin Button style, going in reverse.
There you go.
And what's really cool is like the last page on the last line, it says, "Hi, my name is Jay," and the end of the book. It's kind of like
spoiler.
Yeah, spoiler, and it's okay. There's a lot of really cool intricacies about the book that I'm really excited about. I'm like dying to talk about, but I got to keep it under wraps. I don't want to divulge too much. But it's a book of resilience, determination, hard work. And, you know, when you say that you started with, you know, your folding tables and your folding chairs, you know, I was just at that age. I was 24, almost 25. I had left my previous post at the other company I was at. I wasn't sure what I was going to do. I was not happy. So I left, and, you know, long story short, my wife the next morning kicked me out of the house. She's like, "Go do something. You're not going to sit at home and mope."
Right.
I took my laptop to my buddy's office.
As a good wife should, by the way.
Absolutely. She keeps me in line for sure. Basically, I was sitting in his office with the little Google clicker, just like staring at me for over an hour. And I just typed in synonyms for the word speed, and because I knew I was going to do something in this space, and kind of push comes to shove, you know, I went on GoDaddy and I set up an account and I just started playing with Wix and just had fun with it. And then I got an office. Then I went to my home office and had like a little extra folding table in the house. Took my laptop, threw it on there. A few days later, bought an extra screen and plugged it in. And it just, you know, it was the grit, it was the hunger. And I think that really, you know, like you said, and I resonate with that because it's those who start from kind of nothing who truly appreciate it versus somebody who starts from like means, right?
Right.
And I don't come from, you know, a wealthy background. My parents didn't have money. My in-laws didn't have money. I don't come from money. So thankfully everything I have, you know, was given to me by God, and I worked my behind off for it. You know, stressful nights, 3, 4, 5 o'clock in the morning. But, you know, the art of needing to be successful versus wanting to be successful is exactly the premise of the book, right? I needed to be successful. I did not have any other option. I had no financial backing. I didn't have money in the bank. I had no option. Versus wanting to be successful, which is mommy and daddy have money, and somebody's there to financially back you. You get a beautiful office with gorgeous desks and chairs and chandeliers, etc. And you have 10, 15, 20, and it was handed to you on a platter, right? That wasn't me.
Or someone that just doesn't want to work for it. I mean, both of us, you know, let's set the story straight here. This is after we started in the industry, and this is the first time that we had the conception of our own business. So, you know, a part of my story originally is that I just came back from a study abroad trip, and I had like $2,000 to my name, and I had the opportunity to go to Wall Street, and I was like not going to pass this opportunity up after I learned about the industry a little bit. And I spent the last bit of my life savings, and for the first 3 months barely made any money. And so that's like how sloppy and disorganized, and, you know, there just was nothing to really fall back on. And I think once that, you know, I had a little bit of money in the bank when I started my first business, but that's when the Cisco tables came out, and foldable tables.
I had $50,000 of savings left to live on to start a
Right.
company on with
I probably
no
had a
direction,
smidgen less than you, like at the time, but it was like
no other
40K.
assets.
But it was from brokering. It was like from the business.
I wasn't brokering. I had savings from some commissions that I had made in the past.
Right.
And, you know, from being a sales rep at the other company. But, you know, at a certain point, that wasn't enough. And I had to make a decision, right? You know, I was a month and a half into the company. I had just started. I had 4 employees. And I was like, all right, I'm going to be a funding company.
And was this Velocity
Yeah,
at the time?
This is Velocity.
Okay.
Right? You know, I joke around with people all the time when they spend hundreds of thousands of dollars on logos and marketing. I spent $25 on my logo in Fiverr.
Well, look at ChatGPT nowadays. You don't need to.
So it was, and let's just say this to the youth: we had way less in front of us. I didn't have ChatGPT. I didn't have Claude. I didn't have all this opportunity that would create my website, that would create my infrastructure, create workflow, you know, create deal flow, right? Marketing concepts. I didn't have this.
And to go to UPS at the exact time that the notary was in. So this is just like a lot of things have
I
changed.
remember that, you know, the company where I was at, you know, when the merchant would scan the documents in, and
Right.
it would be out of order. They would make us print it,
Redo
put it
the
in
whole
order,
thing.
and rescan it back in order so that it was in the file accurately.
This just is describing the pre-ChatGPT and all those days.
This was before Cam Scanner.
Yeah.
Okay? Before all of that. This was manual labor.
It's just so much to develop so fast.
Yeah.
But point of the matter is, you overlooked all the details. You just said, you know what, we just got to get started. That's the whole point.
So you know, just to continue, I used the 50K. It was gone within minutes. Literally felt like minutes. And I took a leap of faith, and I had to ask my wife kind of for permission.
Yeah.
But we refinanced the house. And we took the cash.
That's big.
It was $169,000. We took that. We put it back into the company. And I think on a financial level, it was probably the best decision we ever made. But you know, in every business, there's a risk, and then there's an opportunity. But there's no opportunity without risk, right? So you have to take some sort of calculated risk when you know you don't have the capital behind me, right? When I'm starting a funding company without money.
Yeah.
Right. Think about that. Right. That's like starting a construction company without a truck. Right. So you're kind of, you know, up creek without a paddle. And I took a huge leap of faith, but I didn't start with hundreds of millions of dollars to start this big, you know, funding conglomerate. I literally started with 50K of savings and 169,000 from refinancing my home, and just turned it. And turned it and turned it and turned it and compounded and turned it. You know, then I eventually, a year later, raised some capital. Then, you know, had to buy them out. Then COVID. Then a facility, and it just kind of cascaded to where we are today. And you know, if I were to say I would do it again, no.
No, you got to do it all the same.
I would do it the same because I learned so much from it. And it's because of those hard situations that I realized that I feel like our best attributes come out in the time of fear. Right.
Fear put your back against the wall.
Fear fuels opportunity. And when you're scared, and it's in that time of kind of like the oh shit moment, that's when your kind of like true superhero kind of pops out.
Yeah.
And it really brings on the fact of who's resilient, who can handle it. You know, in my book, I'll say this, one of the chapters is called Chewing Glass. And the purpose of chewing glass, the whole concept behind it, is a CEO is there for a reason. The main purpose of a CEO is to chew all of the glass. What's the glass? All the crap that none of your other employees, whether they're Harvard graduate, Stanford graduate, A+, 4.0 GPA, etc., they won't answer and or cannot answer, and they come to you, the D student. They want to ask you what you should do, or what they should do, right? What it comes down to is it's kind of a collective of all the stuff that nobody wants to do, and you have to make that decision. Now, there are brief moments of fun and excitement and pleasure when it comes to, yeah, we funded a good month, and yeah, we had a great quarter, etc. But then it's like short-lived by, oh shit, what happened? Something broke, someone got hurt, something happened, there was an incident, somebody's not able to be in, facilities going, right? There's always something, right? I think I saw one of your videos, you have to find a new attorney and then all the thing, you have an employee, and that's the purpose of a CEO.
There's 100 fires. Which ones we putting out today? Which ones are we going to let burn? Like, exactly. That's part of it.
That's it.
I feel like the more that I grow, the further away from the little wins that I get. So like, I used to get all excited when a deal was funding, and I'd either be ringing the gong myself or be out on the floor, like celebrating with everyone. And now I'm like, oh, like we funded $1 million today, and I'm like drowning in all the problems that no one can handle. And we do find those moments. I mean, we do like little happy hours, and we'll find moments to celebrate.
But do you know why that perspective changed for you? I can tell you why.
Because there's layers and texture to the business now, I would say.
It's lesser that. It's because you went from being a broker to also now being a funder. So when you fund...
Well, I think it's because I went from being self-employed to being a true
boss.
Owner.
Correct. But when it comes to funding versus brokering, the win of a broker deal and you get your commission, it's kind of that high because you funded it. It's yours, right? Now you have to obviously make sure that you don't get a clawback, but when you actually fund a deal...
There's more risk.
It's not just a risk. Like, great, we funded it. Like, why am I celebrating?
You don't celebrate until you at least get to break even.
Exactly. Like, so
After commissions
I tell the
are
team
paid.
all the time, I say, guys, why would we celebrate on funding a deal?
Yeah.
Let's celebrate when we get paid in full.
Yeah, let's celebrate when we look at our default rates.
Yeah, I mean, I have people that come to me all the time, Jay, I funded this and Jay, I funded that. I was like, my exact response every time. How much you get back?
Yeah.
Because it doesn't matter.
Yeah.
I'm not brokering. I don't get a commission the next day or within the week. I have to wait till, the principal initial capital outlay has been paid back. The commissions that I outlaid have to get paid back, right? Then maybe there's some fee in there possibly that might get paid back, and then possibly, the purchase receivable and the return, right? So again, there's a lot of things that have to go right.
Yeah.
And then you have your compound. So the real money is the turn of capital.
Yeah, I still think that there's a subject to like the texture. Like there's certain areas in my org chart where there's 4 layers below me now, and then like within those layers there's leaders and stuff like that. I give my team like up to $250,000. You don't even have to ask me twice. Like I don't even want to see the paper. It's anything above that, I do a quick glance at it. Or if they ask me questions. And so now what I'm noticing is that like I'm really not paying any attention to what funds on a day-to-day basis. I'm really looking at what is our default rate from last month, 2 months ago, 3 months ago, and watching that update every day.
And as you grow, it's going to be every quarter, every other quarter.
Well, we look at quarters in year 2.
I understand, but it goes from, from inception, it goes day to day, week to week, month to month, quarter to quarter, right? So you kind of look at it on a holistic approach, and you want to look at the overall demographic and the detail of what is performing and what is not, but you start realizing that you can't micromanage it all. You can't see it all. Like you said. So we have credit committee on deals over 250. We have credit committee twice a day that we review, with the team. They put it together kind of like on a silver platter. And yeah, I mean, we have our CFO involved and our CRO and our, myself and my head of underwriting. And we just, collectively, look over the deal quickly and what are the, yays and what are the nays. And then we, take a vote. Do we move forward? Yes or no? Right. So as you grow, you have to give your team that kind of autonomy to be able to make those financial decisions. But you have to realize that no matter how hard it is, and I know it's hard because it's hard for me too. It's probably hard for you, that you want to be involved.
Oh,
you know you do.
It's more fun.
But it's so hard to give that up. You just have to. And that's the only way that they're going to grow. You got to throw them in the deep end and have trust that they will handle it even 85 to 90% as, you would. And then hope for the best.
I think it starts with controls. So you put controls in place, allow them to go and make their own decisions. Then you can loosen the controls. I think that's what I found that I've done pretty well.
They have to provide, transactional proof that they can, continue and, make the right decisions. When you're on a P&L base and or you're on a commission base, right? You're just going to push.
Right.
Right. And you're going to hope for the best. But there's nobody that can underwrite a merchant, for example, that, has a heart attack. You're not underwriting their medical records, right? You can't underwrite the fact that, the guy dies on his front lawn. How? You're not going to know
so
that.
many guys
there are so
on
many
our
different
team,
things.
we let people syndicate that that work with us. And there's so many people that are just like so overexposed in one deal because they've been seeing it for 2 or 3 years and they're like, oh, this is a lock or, you know, whatever they choose to describe it. I'm like, yeah, but like you just don't know.
I've always said
what could happen.
Unfortunately, every deal has some semblance of an expiration, right? You know, whether they go out of business, whether they sell the business, whether they, you know, default or they get cheaper financing, right? There's some semblance of some sort of expiration. Now, when? You don't know. A merchant that's been paying you 30 times, well, the 31st may not be the lucky one, right?
You have to re-underwrite every deal every time you
I've
fund.
always told our team, you know, when you're syndicating and you're participating on transactions, and thankfully probably 95% of our team does, I've always said, pick a percentage that you're comfortable with of every deal, no matter the size, doesn't matter. 5%, let's just say. And then a cap dollar to that percentage. Never, ever, ever breach that. Stay disciplined. Let's just say in this scenario, 5% of every deal that I go into with a cap dollar of 10K. That's it. And don't move and just stay there. Just diversify across the platform and just leave it because you stay at your percentage and you will never, ever, ever have that issue. And I've said that, and I created that in my old company. And I literally, when I created Velocity, I really kind of put that in the syndicate guidelines as like beware, you know, this is what you should do. And this is the best practice to make sure that your capital is protected. Now, if you're on a percentage across the platform, you shouldn't have that breach because you're never overexposed. You'll have people that'll do like 5K and then 50K and then 100K and then 2K. I'm like,
and that's where the percentage can get a little skewed.
Correct.
It's what I like to say is percent of invested. So it's like if you give us $100,000, don't go above 5K per deal. And you know, maybe that RTR, rights to receive, ends up being 150 or 200 after a couple years or a few years, whatever it is. And then maybe you can do a reassessment. You can raise to 10 grand, but it's like the lower it is, the more diversified it is. But then you have people that, you know, they bring their own deals to the table and they think they know. And then, you know,
the other thing is that when they're not the capital behind, they forget the fact that they don't have as much turn as the actual fund does, right? So if you're cherry picking a deal here and a deal there, great. We're doing 50, 100 of them a day. So our capital is going like this, and you need to be doing the same thing.
And if the most expensive money is the money that's not being invested.
That's correct, right? So I've always said that there's 4 types of compound in the space, right? Compound number 1 is your payments. Yesterday's cash flow equals tomorrow's funding dollars, right? I fund 100, let's just say 100K deals. That's just say $10 million. I funded today. Let's just say it's $1,000 a day. Make up a number. That means that tomorrow I have 100K coming in. Take the 100K. Tomorrow I'm deploying that 100K. I'm turning that 100K into 101 now, right? So on and so forth. That's number 1. Number 2 is basically your early payoff, where you're getting paid off, you know, earlier than anticipated. They're repurchasing the receivables that you bought from them. Number 3 is your renewal process, where you're buying out the old balance with the new balance. And then number 4 is your facility, where you're borrowing on a borrowing base and rinsing and repeat, kind of step 1, 2, and 3. So that's the kind of way to do it. It's turn and burn consistently. If you're not doing that, you're hurting your portfolio.
Well, let's talk about institutional capital for a second. You know, you mentioned at one point 60 days was a good deal at one point in time. And I know there's still a lot of speculation in the industry, but I think the clout is growing so fast. I think a lot more institutional capital and just private investors in general are becoming attracted to the space. You know, maybe walk us through the story of when you first got institutional financing. Was that the catapult that brought you to the next level? How did you build the track record to be able to obtain that institutional financing in the first place? You know, what's your take on institutional financing in general?
I have a very, it's like a smile and a frown at the same time, right? You know, I'm not going to say that there's not a necessity, obviously, of institutional capital. We are forever grateful for all of our institutional partners. But when you're dealing with a private investor, it's obviously a lot easier. There's less reporting requirements.
Significantly.
There's way less paperwork you have to fill out. I mean, I have a dedicated team just for our facility. We're talking 12 people that is their entire life, is just making sure that the reporting is accurate, that the borrowing bases are up to date, and the waterfall reporting is accurate, the daily remittance reports, the daily, weekly, monthly, quarterly, and annual borrowing base reporting and waterfall reports audited financials. You're talking audited remittance reports. They have their own audit, field audits. I mean, it is an immense amount of work.
Yeah.
You know, when it comes to private capital, obviously you can get smaller dollar amounts, but it is not easy to attain institutional capital. Our first facility was, you know, a large facility that, to be honest, we tripped and fell and just happened to fall on our lap. It was one of the worst decisions we ever made. We were put into a technical default for literally the dumbest reason, and we learned a lot about that. We learned that there are unfortunately a lot of they say that we're the boiler room MCA bad ones, right? So there are a lot of bad apples on the institutional side, and you have to learn how to weed them out. Not saying that they're all bad, they're not, but a lot of them have the bad. How do I say this?
Choose your words wisely.
I don't want to get canceled.
Yeah.
No. They have really bad intentions in mind going into the actual transaction.
Yeah.
Right. You think it's going to be hunky dory, and they have a 9 to 12 month lifespan for you, and they don't care.
Yeah.
They just want to get in. They want to get out. They want to charge you their default fees, and they just want, it's all one big game. So it's really a lot about reputation and understanding their assets under management. It's understanding who they've transacted with before and getting, references from those people. But it's not just they give you money and then you make a lot of money and then there's nothing. I mean, there are probes everywhere, in your ears, in your eyes, in your nose, places where the sun don't shine, and they see it. They have access to your accounts, they have access to your systems, and they watch and monitor you. And they're protecting their capital, rightfully so.
Yeah.
But it's not rainbows and sunshine.
Well, everyone that wants to get started in the space, I think they start with personal cash or friends and family, and then they grow to maybe a base of investors. But if you do really want to be a major name, you need institutional capital. Yeah. It's the only way to do it. And in order to grow, you have to get clean with your reporting. We're in the process of closing on our first institutional deal, so we're really excited about that, $40 million. And with that being said, the reporting is just a whole different game.
Pass it by me first. I'll let you know if they're a good apple or not.
Yeah, we'll talk about it after this. You'd be surprised at the deal that I worked out. But regardless, the reporting is just so different, and it really is a growing pain that I never thought would be so difficult. It's kind of fun. I actually enjoy this more than we're kind of building like a little broker arm to our CRM, and that's actually more painful than what the reporting for the institutional capital is. But it's definitely taught me a lot. It's a whole different piece of the business is what it feels like. So would that be where you felt like your career started to take off after this technical default took place? You found a new partner.
Yes and no.
Where did Velocity become Velocity?
I think where Velocity truly became Velocity was, when we started to realize that the worst possible incident to our industry, which was COVID, where businesses they were prevented and restricted and disallowed to operate. And that is the entire kind of what we do, the entirety. And when they were prevented from operating and we were able to survive that just showed us that we had enough resilience to kind of break through barriers that we didn't ever think, in a single chance possible. So I think where our true success was if that couldn't stop us, I'm not really sure anything, including a technical default, including, employees and facilities and investors and syndicates leaving us, etc. All right, we got through the worst possible situation.
Yeah.
We can get through pretty much anything else. And it really showed our, team and even myself that it is, it's kind of one of those things where, as I tell our team, if we're not going through some sort of struggle every 3 to 4 years, we're not succeeding because we're not pushing enough barriers.
You're not
right?
growing.
Every small business has to be going through some sort of struggle every 2, 3, or maximum 4 years. If you're not, you are not pissing off the right people. You're not breaching the right hurdles. You are not getting past that next level. It's kind of like Super Mario. You know what I'm saying? You got to get to the next level to get to the next, what is it? The mushroom or cherry, I forgot back in the day, right? So for us, it's kind of like we got to push the envelope, right?
Yeah.
It's never enough. When our team, you said before, when we celebrate, it's not a celebration. It's next, more. All right, what's next? What's the next deal? Great, let's get the next one.
Yeah.
There's never a time to really celebrate until, all right, we have our holiday party, and obviously we have our office barbecue, and we have office outing. We're doing a NBA Finals, view in my house, etc. But yeah, we obviously have a good time, but we don't get complacent. We don't just sit there and be like, all right, we funded a lot this month. Let's sit back and do nothing this month.
Right.
It's always a constant. Small businesses always need operational capital. There's always the next technology. There's always the next automation. There's always the next arm. There's always something.
Now AI with bank parsing is huge.
Yeah.
I know you've invested significantly into that. I mean, that has changed the game.
Yeah, I mean, we went from, having over 170 people overseas. I'm glad you brought that up. Between Tijuana, Mexico, and the Philippines. Excuse me. We had 172 employees, and they were doing just data entry, manual, paying them $20 a day. That's literally what they were asking. And we got to a point where we're like, this is crazy. We needed VPNs, and we needed separated inboxes, and we were getting kicked out of Gmail. We opened a box. We had subs 1, subs 2, sub 0. We had velocity subs. We had consistently having to add new ones. We had to add incognito modes because we had too many people in at once, and we were getting kicked out of our own Gmail, and we had to forward over submissions into new boxes, right? So we had to figure out a better way. So we basically automated the entire process from soup to nuts. Whereas today, we can process a deal with credit, background, court search, Unicorp, TLO, Lexis, Clear, data merge, a full AI scrub about the business, a web scrape, bank parsing, application information, fully rebranded documentation, a full detailed analysis and an AI review of the transaction for us to understand, is this a deal that we want to fund based on past demographical transactions, based on details, whether it's hair color, eye color, height, weight, whether it was a Yahoo or a Gmail account that the merchant had in the past, and specific demographic transactions up to, I think it's roughly 2,800 different detailed, de-anonymized small business data points that we analyze on a given transaction. And we take that within literally less than 60 seconds. We have all of what I just discussed.
How much human interaction?
Zero.
And
then it takes all of that data.
Maybe
and
just, hey, we're
it.
missing a month bank statement. Like, let's
Well,
clean
everybody
it up.
knows that. So the
Right.
system automatically identifies, well, it's missing a statement, come back, send the notification email. But all of that, which happens within less than 30 to 60 seconds, and then it plops it in front of an underwriter's desk. And it says, here's the anticipated offer. Do you agree?
Yeah.
And how does it know that? It's learned our way of underwriting in the past.
That's awesome.
And then for us, we can provide proof of it. We've submitted offers within minutes, like 2 minutes, 3 minutes, with a human review, with a human writing the information, and back to the original email thread, right? We're coming to a point whereas we're near to kind of nearly automated underwriting, as good, if not maybe better than a human. I do foresee that, in the near future for us, full autonomous AI checkout is something that we are finalizing now, whereas we have sheer confidence that before funding, based on, for example, month-to-date verification via custodial Plaid, right? Whereas we created a partnership with Plaid, whereas we can access their account and we can see what's happening in real time, right? We take that information, we cross-reference it with the bank statements, we verify that they're legitimate and making sure that it's accurate. We then verify the debt to income again. We look at all the details of what the AI has anticipated based on the previous underwriter that looked at 950 deals just like this one that we have funded in the past and what we have made based on a decision. And based on that, yay or nay. Right, so near instant.
This monologue right here is just so impressive because I remember calling you. I know what all these systems, like I was talking to you quite a bit when these systems were being built, and I started working with your team a little bit and I ended up going my own direction. And like, there's just so many, it's like all the puzzle pieces are out there, but getting a technology team to actually pull it all together to be as seamless as what you just described. Like, I'm over here like, man, I'm jealous of that.
Yeah.
I'm jealous of that.
We're doing some crazy stuff, dude. We're doing predictive default measures.
That's how the industry grows. I mean, the biggest player arguably would be On Deck, I guess, that has the brand. I mean, who's bigger than On Deck? I guess Loan Builder. You got
PayPal,
Intuit, QuickBooks. Loan Builder is PayPal, but On Deck's top 5, and everything they do is basically automated. So they've
yes
just
and
like
no. I mean, On Deck has like 3,900 people in like Costa Rica.
Yeah.
That do a lot of the the manual stuff, right? So I was telling our team the other day that there's a reason why people think that banks are super automated, right? You go to Chase and you go to Wells Fargo and Santander. Do you know the reason why banks are open 9 to 5 and why you can't send a wire before 9 and or after 5? Because the way it works is that when the bank sees your trigger, it's an API trigger, right? So it triggers, when you say send wire, it sends a notification to the bank. The bank manually processes that transaction and they type it in and click send to the receiving bank. So 9 to 5 is the average workday.
Yeah.
That's why you can't send a wire before 9 and or after 5, because somebody human has to be involved.
Interesting.
That's the problem. 90% of banks do not have traditional APIs. They don't have as much infrastructure and technology as they say they do. And it's crazy, but it's true.
And I've talked to a lot of CEOs that are really pushing the online checkout agenda. So it sounds like you're pretty damn close to it. But that's the biggest reason why someone would take a more expensive type of financing product is speed, right? If you can get that online checkout in 5 minutes, ready to go, right in front of you, it's the easiest hassle-free process. When do you think you'll be able to go live with something like that?
Let me ask you a question. Most of that can only be transacted during work hours.
Yeah. Well, you can still execute the online checkout, potentially submit an ACH request, but then it would come,
what if
a
you can
business
access
day
the
and a half
capital
later.
in real time? Let's just say 12 o'clock at night and Lowe's is still open.
Will you tell me how to do that?
Well, that's what we're building.
Okay.
We're working on 24 hours a day, 7 days a week, full access, whereas they can access their capital in real time and they don't have to wait.
Is that on credit or is that circumventing the bank somehow?
Both.
Okay.
So there's a decentralized process that we created that allows, number one, access via a debit card. So a merchant can access their line of credit through us or their capital through us online, and they can access it directly. They can say, send it to me via ACH. I'll get it Monday. That's fine. Or give it to me on a debit card. They get a debit card access. It's a electronic debit card, and they can access that capital right then and there. And then there's also a decentralized product that we just created with basically the Fed now. And that allows us to transact small businesses and give them capital any time of day, any time of night, 24 hours a day, 7 days a week.
So you said with the Fed. Explain that a little bit more.
Yeah, so there's a process called Fed Now. So Fed Now is a newer product that allows banking institutions to offer after-hours finance to institutions like ours, right? Where we can access our capital when they know that there's a certain amount of money in the account, and they will then allow us. It's kind of like a midnight Zelle, to say the least.
Yeah.
Right.
Well, that's what I was thinking in my head the whole time, is like a Zelle transaction, but for a larger dollar amount. The cash has to be
24 hours,
reserve.
correct. So it's almost exactly what it is. So we created an exclusive partnership to allow us access to doing that. One of the first, honestly, that has been able to. It's exciting. It gives us the ability to truly allow small businesses to access capital at the time of when they need it in real time. So if somebody says, I need capital, they don't have to then fill out an application, go online, update their state. It's Plaid, verify, application, online, within seconds, approved based on our automation and underwriting, and say auto checkout, and you could literally be in, for example, Lowe's at 10 o'clock at night if they're still open, and get approved, get the funding, and have the actual capital in your hand within less than 10 minutes.
So you'd be definitely the first person to be able to do this.
Correct.
That is incredible.
So, I mean, we're really pushing the boundaries.
Yeah.
There are a lot of companies that don't embrace automation and technology. We are like knee deep. We're like eyes deep. And I think that it's those who truly embrace it and automate that will have the ability to deploy capital, number one. Because, you know, as a funder, it's not, you know, it was one of the questions we discussed, which is what differentiates a funder from, you know, a lender? And what is it that it differentiates between somebody who can actually deploy capital to deploying capital responsibly? Anybody can push money. Anybody. It's the easiest thing. Hey, you want money? Sure, great. But it's collections. It's discipline. It's having the understanding of infrastructure and regulation. And then if I strip that all away and start it over again, can I do it again? Right? Can I have a relationship with a good broker like you guys? Yeah. Can I then strip everything I own and call you back for that relationship? Yeah. Right? If I sold the company today and I was able to call brokers, do I have a relationship with them so good that I can call them back tomorrow? Hey, I'm starting my own company again. Would you like to submit deals to me? And I would say 99.9% of our brokers are going to say yes, because we have that personal relationship with them. It is not take the money, here's a commission, F off.
Right.
We have a personal bond. We send them lunch. We send them cheesecakes right before the holiday. We send them, you know, to basketball games and sport games. We make sure the reps go to their offices as much as possible. We are interactive, and we build a bond that, yeah, okay, great. Maybe we're not the biggest lender. Maybe we don't have the most money. Maybe we don't have the best deals every single time, right? Half your office had my offers, right?
Oh,
like
yeah.
you said. So
Some of them close, though.
that's good. I wouldn't know, honestly, at this point.
No.
But the fact is that it's building something that people would be willing to come back to, and you have a discipline enough that it doesn't matter if I have $1 billion in the bank, I'm still having the same model, whereas I'm disciplined. I am going to stay in my box. I don't care how much money I have to deploy. I told every facility we've ever spoken to, put $3 billion in my account, I'm still not funding a bad deal. I don't care. It's my reputation.
Yeah.
That is the only thing
And
I cannot change.
I think that is the biggest struggle with growing entrepreneurs in the funding space is once they have all that cash, they feel the obligation to get it out, and that's when they write bad deals.
I think it's not just that. I think that they get high and mighty. They forget their morals. They forget where they came from. They forget their religion. They forget who they are as a person. They start acting rude. They become kind of an unconscionable reality that is not who they are because the money has gotten to their head.
Right.
And, you know, the way I've always thought, and, you know, I've told this to my wife 100 times, you know, I don't care if there's $1 billion in the bank. I'm the same guy. You know, I actually had a broker call me up 2 years ago. And I'll never forget it. His name is Tony. And he said, Jay, he's like, I've known you since 2009. He's like, you are the same idiot from 2009. And I took that with such respect.
Yeah.
Because he said to me straight, he's like, you didn't change your religious perspective. He said, you didn't change who you are as a person. You're still the same quirky guy. You're still the same honest guy. He's like, nothing has changed. But I cannot even remotely tell you how many people I know that started in this industry as a religious person. They're completely off. That they were honest, they are now dishonest. They have, they were, good to their spouse, terrible to their spouse, right? They just change because the money has gone to their head. And you cannot let it. Yeah. And so what I always think about is I'm broke. In my head, I'm broke.
That's how you keep your back against the wall.
That's it. Because if I'm broke, I'm going to keep hustling.
There you go.
If I'm broke, I'm going to be the same guy because I want to be the same guy. If I'm broke, I'm still the same husband. The money hasn't gotten to me. I don't let it.
Yeah.
Now, I've had a lot of people in my office that sometimes it has gotten to them, and I had to sit them down and kind of, hush them down a little bit, some rowdy people. And that's fine. Sales be sales. But it's the perspective of you're building something greater. And that's why I say it's not MCA, it's revenue-based finance, because we are creative finance. We are structured. We're fintech. And I'm not talking about integrated technology within the financial institution. We are the financial technology. We are the infrastructure. We are the banking of the future. And I'll say this right now. I've said this to our team. Literally, I said it to them last week. I said it to them last month. The way banks underwrite transactionally, whether it's a real estate transaction, an equipment finance, a factoring, whether it's a bank loan, etc., they look at your pro forma. And they look at, yes, the future rent roll. And yes, they look at your projected financials. They don't look at your banks. They don't look at your month to date. They don't look at your cash flow. They look at your top line and your bottom line. Now, maybe you can tell me, but based on financials that I've seen, it is really easy to fake those.
Oh yeah,
you could change that.
There's tactics you can. Yeah, there's tactics like we'll look at properties to see if things have been edited from the original. That's how you can tell bank statements. But you always got to find tax returns that a CPA is actually signed off on. If there's no signature there, then you got to be really careful.
Even if not, you can actually cross-reference a month to date, meaning a login.
Yeah.
With an actual statement, and they match when you're logging in, right?
Yeah.
So you can't log into our financials and be like, oh, they didn't edit it, right? So the banks aren't doing that. I've said this, I'll say it here, I'll say it now. Banks in the next 2 to 4 years will adopt, when it comes to small business banking and SBA lending, et cetera, they will adopt the way we underwrite. Guaranteed.
Yeah.
Because they will realize that the way that they're underwriting is so antiquated and it's almost unverifiable.
Well, they're leaving money on the table. I mean, you look at Intuit QuickBooks, I'm sure they found a capital partner to be able to deploy capital. You look at PayPal Loan Builder, I'm sure they found a capital partner. They bought Swift.
Yep.
Financial, I believe, in order to facilitate their underwriting.
Those were my old days.
Yeah, I think that was right when I first started the industry. Let's do this last question and then we'll wrap up. So we're talking a lot about this newly integrated world, a lot of technology, but you kind of went on down a little bit of a rabbit hole at how you keep great relationships with people. How do you maintain that sense of personality and humanness in a world that's becoming so much more AI driven, where you might be pressured to release employees, fire them, lay people off, things of that nature, but more importantly, maybe you're generating business on your own as opposed to being so reliant on brokerage shops. Like, tell me how you foresee maintaining that relationship between growing technology and then human relationship.
On a reputational level and on a personal and relationship level. I know every single one of my employees by first and last name. I know every single one of my employees' spouses by first and last name. That's great. I know their kids' names. I know where they live. I know how long they've been with the company, right? And I would say probably some of the brokers that have been with us for numerous years, I know the same, right? On a personal level, there's transactional and then there's also personal. You kind of have to blend a little bit of both, right? When you're dealing with a broker, when was the last time you took them out to dinner? When was the last time you took them to a game? When was the last time you just sat down and shot the shit over a beer, right? They're people too. And the funders are also, right? You could joke with them. You can have a good time with them. You sit down, you invite them to a barbecue and a cookout. But they're humans.
Yeah.
And you got to treat them like that. And same with merchants. And same with employees. I treat my employees like I would treat my own self, sometimes better.
Yeah.
So in that aspect, if somebody's adding value, to answer your question, and yes, AI can take over their job, granted, there's two ways of looking at it. One, I can get rid of their job with AI automation technology. Or two, I itemize and I understand exactly what that person's doing on a day-to-day basis. And I literally today had a meeting with somebody that, please God, I'm about to hire, and I'm calling him my maestro, right? Kind of my conductor.
It's an official job title.
Literally. And there's no job title for this, right? So their job is to integrate. Correct. Their job is to create infrastructure around each and every individual employee. Make them greater than what they are. How? With Claude agents and AI agents, et cetera, and create, let's just say, my marketing people. Give them kind of like tentacles, more content, more availability, more automation, and make them better. And do that with each and every individual employee. You could take what we have from 176 employees today to 6,000 employees without actually having to pay for 6,000 employees, right? So you can kind of pour gasoline on what you already have. Now, obviously, if there are bad apples and bad employees and things you have to get rid of, that's par for the course. But when it comes to giving them the tools and the infrastructure to be something greater, that's the CEO's responsibility. I tell my team all the time, I have two main objectives when I come to the office every single day. Probably one of the only CEOs in the industry that still comes in every single day. Number one, I come in with a smile, right? The morale, if I come in with a frown, people see it, they feel it, they hate it, it doesn't go well, right? They wonder what's going on, what's the problem, the morale goes in the trash. But number two, my main, I would say goal every day is how can I make them more money? It's very simple. If I make them more money, they work harder, they make us more money. They scratch ours, we scratch theirs. Sorry, we scratch theirs, they scratch ours, excuse me, right? So as a CEO, there's a lot of larger institutions that I've seen that are, kind of surviving on the backs of their employees, and they're not treating them well, not treating them with respect. They're not giving them that commission or bonus or things of that sort because they're like, well, you didn't stay in long enough, so you don't deserve it, right? Everybody wants a little extra. Everybody. If you give them the opportunity for that, they will work harder. It's kind of like, giving a treat, right, to your kid. You behaved, you get a treat. Then they behave again and they want another treat, right? So as long as you're feeding your employees and you're making sure that they are handled. Like I've had instances where I've had employees literally say, I'm having trouble with, for example, I had one that said he couldn't pay his credit card bill. It was like $6,000. I wrote him a check out of my personal checkbook and I helped him pay it. I'm not saying that to gloat, but that's the type of employer wants that employee to succeed.
Yeah.
And it's that personal touch. And if you add that with, as a human, people will stay with you for a long time. And AI, schmai doesn't really matter because their hard work and dedication it'll outwork any AI eventually because they have your dedication.
Awesome. Well, listen, Jay, I think there's been a lot of industry talk. I think it got a little technical, which I love. I mean, that's always something that, I think there's not enough people talking about this stuff. And I think it's really cool to create a platform for it. I think you shedded a lot of light on leadership and strategy and your struggles. And it's just really good to chat with you as another veteran within the industry.
Absolutely.
Is there any call to action you want to give? Sign up with Velocity. Here's my handle.
I mean, obviously, to all of our, merchants and brokers, we appreciate you. And my book is coming out, Need It, Don't Want It. You can get it in, Amazon, Barnes & Noble, coming out, thankfully, produced by Forbes, coming out in end of October of this year. Very excited. Pre-sales start in July, and it'll be posted on our Instagram handle, or mine, it would be at @JVigdor or at Velocity Capital Group. I think it's at Velocity CG. Happy to answer any other questions.
Awesome. We appreciate it, man. Hell yeah.
Absolutely.